Okay, now we come to the punchline, and perhaps the most important part of this course. One of the main reasons why interest rate swaps are so heavily traded is that they are very helpful for financial institutions to manage the mismatch that they have between their assets and liabilities. Okay? So we talked a little bit about asset liability management in financial institutions already. We saw an example in one of the previous sections of a bank, and we saw that there was this natural mismatch between the assets and the liabilities. It was hard for the manager to adjust the durations of these two sides of the balance sheet in a simple way, and therefore that created interest rate risk for the equity of the bank. Okay? So what we will see now is exactly how to use interest rate swaps to manage that risk. So to be able to quantify exactly how much interest rate swaps we need to trade, we first need to define what is the duration or the dollar duration of a swap. So recall the interest rate swap in the beginning is a zero investment portfolio. It has a price of zero. So we are going to use the duration that we developed for that end, which is the dollar duration. Okay. All right, so what is the dollar duration of a swap? At inception, at the beginning, when the swap is created, the dollar duration is given by the formula of the dollar duration of a portfolio. An interest rate swap is a portfolio of a fixed rate bond and a floating rate bond. So the dollar duration of the portfolio is one minus the other. So I just have to be careful with the signs. I'm going to compute the duration from the point of view of the fixed receiver. So I have a plus sign on the fixed leg and the minus sign on the floating leg. Okay. So recall from the formula that what I would have here would be the dollar duration. But since we are at inception, in the beginning of the swap, both bonds have a price of 1 or 100%. Okay, so the dollar duration is just 1 times the standard duration, which is what you see here. Okay. So an example. Let's consider a 10-year swap that pays a fixed rate of 4% against the 6-month LIBOR. Right? And let's say that the term structure right now is flat at that same 4%. Right? So how do I compute the duration of the swap? Here it is again. So this is the timeline of the swap, a 10-year swap. This is the fixed leg, 4% divided by 2 every 6 months until the end. And then the floating leg is the 6-month LIBOR divided by 2 until the end. Okay. I want this to look like a bond or like 2 bonds. So I'm going to add the face value on both legs as we did before. And it's okay because the 2 cancel. And now this is exactly a fixed rate bond and a floating rate bond. Okay, so what is the duration, the standard duration of a fixed rate bond? Well, it's the usual calculation. I compute the duration of this bond, right? Using the formula for duration that we have seen before. It's a long calculation, but it's easy to do, so I'm not going to do it here. You can check this number using Excel or something like that. The duration of the floating rate bond, that is this part here, it's even simpler. As we know, it's just the time until the next reset date, so I don't even need to do any calculations. It's immediately 0.5. Okay, so using the formula that we had in the handouts, the dollar duration of the whole thing, of the package, of the swap, is the dollar. Again, I'm taking the point of view of the fixed receiver, so it's plus fixed minus floating. All right. So I'm not going to specify the notional yet, so I'll just leave this as a variable n, which we will determine later. But it's going to be whatever that notional is times 784 years. Okay, so now PDF. So now let's do asset liability with this swap. Okay. So the idea is the following: the bank manager is going to trade a swap to manage the risk that existed in the balance sheet, right? So basically, we are going to have the dollar duration of the equity after the adjustment. So we put there a star. which is going to be the dollar duration of the equity that exists in the balance sheet as it is, so just the difference between the assets and the liabilities, like we computed in a previous example. And then I'm going to add a swap to it, such that the combined duration of this whole thing, the balance sheet plus the swap, is as much as I want. So in the limit, I could set this duration to 0, and the equity would be perfectly hedged against interest rate risk. Right? So going back to the example we did a few sections ago, we had a bank, a commercial bank, that had long assets and short liabilities that created a mismatch, because again the duration of the assets was much larger than the duration of the liabilities, which was shorter, and that mismatch created a lot of risk for the shareholders, right? So we did all these calculations already. We computed the dollar duration of the assets back there, the dollar duration of the equity back there, and by difference this was the dollar duration of the equity, which again, as you can see, is a large number, which reflects this mismatch between very long assets and short liabilities. Okay. So how much swap does the bank need to trade? How much swaps does the bank need to trade to manage this risk? Okay. So let's use the swap of the previous example to find what is the notional that would set the duration of equity to 0. Right? Well, since we already did all the calculations, this is now easy. So this is the dollar duration of the equity in the balance sheet as it is now, which we computed in the previous example. And now I'm going to add a swap, an interest rate swap, which has a dollar duration that we just computed, notional times 784 years. Okay. So basically I'm going to solve for the notional. That makes this whole thing be 0. Right? So solving for the notional, I get this amount of notional that I need to trade in the swap to make the dollar duration of the equity of the bank equal to 0. And that's it. Oh, just one more detail, which is, again, the signs matter. So I started by computing the dollar duration of the swap for the fixed receiver. At the end of the calculations, I find the notional with a negative sign. So if I find a negative sign for the notional, it means that I should trade a swap not as the fixed receiver, but as the other side of the swap, as a fixed payer. So the bank should enter into the swap as a fixed payer, and that should be the amount. Okay. So quantitatively, that's the answer. What we need to do. Intuitively, this also makes sense, right? Because if we are entering the swap as paying fixed, what we are basically doing is we are taking the income that comes from the assets. We are paying that income in the swap, and in return we are receiving floating. So basically what the swap is doing is making the assets look more like a floating rate bond, right? And the floating rate bond has a lower duration. So the net effect is that these assets that had a big duration now have a smaller duration. It is as if the assets had a smaller duration, which is more in line with the duration of the liabilities, and therefore the net becomes, in this extreme example, risk-free with a dollar duration of 0. Okay.